Happy Thursday, Anthony Special here with Special Analysis, unedited and on the edge of the market. I hope you guys are having a wonderful week. Week's winding down, so I wanted to kind of take a minute today and discuss something that I feel like is really important. I'm a trader and I'm an investor. And the way I do those things, I do them very differently. When I'm trading, I like to trade things that are leveraged. I mean, I'm interested in getting in, making a lot of money, and getting out. When it comes to investing, I want to obviously invest my money in something with long-term growth, something that pays me back, something that increases in value, whether that's stocks, dividend-paying, particular companies, real estate, things of that nature. So I want to just put something in perspective today. If you tell me that something's setting up, a trade is setting up on Ford or on Chevron or on Tesla or Google or whatever, pick the equity. The likeliness is that I'm going to probably look for a call or put option depending on the direction in which we anticipate the trade to set up upon. And the reason I want to do that is, A, it caps my risk. I can only risk the premium I paid for the option. B, I get a leveraged position. If the trade does go in the direction I anticipate it to, I get to make a lot of money. I mean, several 100% is not unheard of. Whereas if I were to buy or sell a particular stock, yeah, maybe I can, get 10, 12% if I'm lucky, 5 to 8%, depending on how much the market moves and how quickly. Now, the market, of course, is in a finicky place. We're obviously seeing things swing from high to low very, very quickly. So for me, I gravitate towards something that is much more appealing and much safer in that instance. And the reason I say that, again, when I buy a call or put option, I can simply only lose the premium I paid for those options. So if it all goes bad, if the bottom happens to fall out while I'm in a position and it goes the wrong way, again, I can only lose that premium. So I kind of want to take today as an opportunity to show you what that looks like. I have a trade idea we're going to look at, and then we're going to go to the options market and kind of see what's available. So that's what we're going to do. I'm going to pull up the chart real quick, and we're going to dive right in. So we're going to be looking at Ford Motor Car Company today, and that was on the left side of your screen. And on the right side of your screen is what we call an option chain. Now, we're looking at two option chains, one that expires in June and one that expires in September. And I've highlighted the put option that I would be interested in buying. And I'm going to tell you why. So first, let's start on the chart. You can see price has broken down. We have what we consider a 1+% confirmation, which all of you know that have been with me for a little bit, that have watched me. My analysis is, always looking for that confirmation, particularly on a weekly basis. So what you see is a weekly chart, meaning each bar or each candle represents one entire week's worth of price action. So when I get a weekly settlement above or below a structure, it gives me the opportunity to now trade towards the next structure of support or resistance. So what I had was a shorting opportunity right at about $14. You can see that indicated clearly on the screen by the red line. Above which you see 15.25, that's where I would place my stop, because that's where I believe the buyers and sellers had duked it out and the sellers had won, meaning they have overcome the ability for the buyers to turn the price higher. So if in fact the price does retrace to that area, that's where I want to get out of my trade, simply because the sellers are no longer in control. If my side of the trade is no longer in control, I don't want to be in the trade. It's that simple. So as long as the sellers remain in control, I want to stay in my short position. Now, I have also tagged an area of where I would consider taking my profit. Now, you could see that channel is what we call descending, meaning as time goes on, it progressively gets lower, 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 lower. As it does that, the gap of my reward gets bigger, 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 bigger. So I placed my target at about 1165. As time goes on, and if this takes several weeks to transpire, that target could drop a little further, making our reward a little bit bigger. But here nor there, I'm going to base my plan off of my entry. My entry here is short at 14. I want to buy it back somewhere around 1165 as of today. Let's call it $12. We're going to round up because the option chain is dollar for dollar. So you can see that I've highlighted here on my screen. Here's the $12 strike price. on the put, and here's the $12 strike price on the put here. So we have two different dates. We have the June expiration, which leaves us about 37 trading days. And then we have the September expiration, which leaves us about 128 trading days. Now, I don't think this is going to take very long. But with that being said, I would call this or consider this a 3 to 5 week sell signal. So I'm going to run into a little bit of an issue on the June expiration for a couple reasons. A, 37 days does not buy me 3 to 5 weeks. And B, I'm going to start to run into time decay at my last 30 days. So unless this trade really just runs real fast and real hard, the likeliness is the June is not the right expiration to pick. The right expiration in this instance is to pick the September. Now, I know we're not going to need 128 days if this trade does what we anticipate it to. But the reality is we're going to sell ourselves short, and we're going to hurt ourselves in the long run. So picking the right expiration, picking the right strike is really, really, really important. I'm a big fan of buying out of the money. And the reason I buy out of the money is because it puts me at a place where I put less money up and I get more money back as long as my trade does what I anticipate it to. So if this trade does what I anticipate it to, if we run through $12 towards our descending support, which at the time that we reach it should be well below $12, that $12 call option that we could buy roughly for about 97 cents today, you can see that right here. Here's the mid. So if you wanted to buy this put option today, betting on Ford to go down, and we bought a $12 strike price with an expiration of September, you could buy that right this second for 97 cents. So for $97, you could be in this trade for as little as $97, which is great. Now, listen, this is not a huge trade on a percentage basis. It's not moving a huge amount. But if we could take 97 cents and potentially turn that into, I don't know, let's call it $1.97, somewhere in that neighborhood, or $1.80, where you could see the prices at in the money right now. I mean, you've just about doubled your money. You've just about got 100% return on investment in what I would anticipate to be a 3 to 5 week time frame. That's not awful, guys. I mean, it's really not. At the end of the day, of course, you're only leveraging the premium that you paid. If this trade goes wrong, let's just say for whatever reason, Ford comes out, says something, blah, 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 and it shoots to the roof. All you can lose is the premium you paid for the put option. But in my opinion, if the price hit the stop, I'd close it. Yeah, I would probably take a hit. But here nor there, I'm out. I preserved some of my premium, and I live to trade another day. But I also know going into this trade that, hey, all I can potentially lose is the premium I paid. So picking, again, the reason I wanted to put this video together is I wanted those of you who are not very option savvy, and this is very elementary, this is very tiptoeing into options, but this is the way I teach it to my live classes. This is the way I give it to my students. I want them to have the simplest approach, not confusing, and minimize the risk. To me, the most important thing you can do as a trader is minimize your risk, because you always want to be able to live to trade another day. So the thought process again, because when we look at this, when we have a buy or sell signal, we need to determine how long does that buy or sell signal likely going to take. Once we know what that time frame is, then we can then pick the proper expiration. Yes, we're paying much more premium. You could see 97 cents compared to 38 cents here. Here's your mid, 38 cents, 37 cents. Yes, is it much more? Yes, it's much more. But the reality is there's a good chance that this is going to expire worthless based on time, not because the trade didn't do what we anticipated it to do, where this has given you more of an opportunity to let this trade breathe on timing and transpire. So that's kind of the spiel for today. I wanted to just kind of touch base on this, show you guys so that you see it firsthand, what it looks like on the chart, what it looks like on the option chain, what the thought process is going from A to B. so that you guys can put this together for yourself. But of course, you know, I'm always here to support you. If you ever have questions, comments, concerns, you want me to look at something or try to give you a curbside opinion, I'd be willing to do that. You can reach out to me anytime. Info@specialanalysis.com. I'd be more than happy to personally get back in contact with you and walk you through whatever you're struggling with. Again, I can't offer you unique or personal trading advice per se, but I can always give you my curbside opinion. So legally, that I can certainly do for you, and I'm willing to do for you. Again, I built this free program to give back to traders that are trying to grow, trying to become better, who are in the process of learning. Trading is a journey. It's something that you can do for the rest of your life once you've acquired the skill set, and it's a constant learning battle. It's always something to interpret, always a different way to look at the market, and I'm here to bounce those ideas off of. I really do this because I needed this when I was becoming a trader, and I didn't have it, so I give back by doing it for all of you. So with that, I wish you a beautiful and blessed day. Guys, as always, if you find value in these videos, if you're enjoying them, please below, like, share, subscribe. I would love to, share this content and information with as many folks as I possibly can. So again, have a great day, and I look forward to talking to you tomorrow.